Yes. Yesterday we were discussing about employee stock option plan. What do you mean by this? What do you mean by this? Nothing but it is an option given to employees to exercise the shares, right? To get the shares of the company at a concessional rates. Why the company will do that? Either to get the targets, target based work done, or to make sure they retain the employees for few years, right? So it might be for any reason. ESOP could be for any reason, but what is the benefit to the employees, sir? They will get the shares at less than the market price. So, and it is the option given to the employees. Okay, it is the option given to the employees, which means after the time allowed to them, like vesting, employees either can choose to exercise it or not to exercise it. Basically, if the employees, complete the vesting period and all, then if the market price is much greater than the exercise price, then usually they will exercise it, right? So, what do you mean by vesting period is the thing now, period in which the terms related to vesting to be satisfied by the employees. For example, company might ask, in 2 years you have to achieve so much sales. Then 2 years is a vesting period. Or it might ask 3 years you have to stay with us. So, that will be the vesting period. Got it? So, exercise period means after completion of vesting period, whoever the employees completes the vesting period, whoever the employees completes the vesting period, we are going to give them some time, allow them some time to decide whether to exercise or not. If they want to exercise or not, based on that, we have given them some time to exercise the option, right? Purchase the shares. That period is called as a exercise period. If within the exercise period, if the options are not exercised, then it will get lapsed, right? It will get lapsed, and exercise price is the price at which stocks are offered to the employees. And fair value of the option means exact value of the option, what we are giving it to our employees. That is market value on the date of grant minus fair value. The exercise price, right? You will get fair value, which means your expense. How much is the expense to the company? For example, 100 rupees is the value of the share in the market. You are offering it to your employees at 40%, which means around 60 rupees will be the expense to the company. If at all they go and issue in the market, they will get 100 rupees. As they are giving it to the employees, they are getting only 40 rupees. So 60 rupees is the expense. Why company incurs, sir? Might be many reasons. Incurring that 60 rupees, now employees are working properly, working for many number of years, so automatically the employee turnover will decrease. If employee turnover will decrease means many cost will be decreased, training cost, selection cost, blah blah blah, yes or no? So company might gain from it there, but here it will be expense only. Which expense it is? The benefit given to employees it is, so it is employee benefit expense account. Employee benefit expense account. All your salary and all where we book in P&L, same expense it will be. What do you mean by grant date? Date on which the option is granted. We are telling them, boss, here is the option. If you want to go for it, you have to do this. So the day when we tell no, you have an option. If you stay for so many years and all, that date will be called as grant date. Are we going to record anything in the accounts on the grant date? The answer is no, because it's not a transaction. Correct? Okay. So, vesting period, we are going to, for accounting point of view, we are going to divide the vesting period into two. Right? One, where the vesting period gets over in the same year the grant is given. For example, grant is given, the grant rights options have been granted on 1st April 2024. Now, if the vesting period is within the year 24-25, somewhere in between the year 24-25, then we can tell it as it is vesting in a same year. Okay, vesting in a same year. If at all it goes beyond 1 year, here we are not considering the exercise period, we are considering only vesting period. If at all vesting period goes beyond the year in which the options are granted, then that is known as extended beyond the accounting period in which it is granted. Why we are going to divide, sir? Because to account for it. To account for it, that is, if at all vesting period is same, that means whatever you have incurred no expense, that will be only relating to that year. That will be only relating to that particular year. Benefit won't be there for other years. Correct? If I ask you on 1st April, if you stay till 31st March, you will get the shares. Now you stay till 31st March. After that you stay or no, that doesn't matter for this ESOP. You stayed on 31st March, you are eligible for option. Now this will be expense for the 24-25, no, not beyond that, because they are getting benefit from that only till 24-25. So whatever the expense we incurred, we are going to book it in the same year. Correct? Whatever the expense we incur, we are going to book it in the same year. But if the vesting period is beyond one accounting period, then for example, if I ask you to stay for 3 years and our value of the option is around 30,000, right? Which means from that 30,000 rupees expense, we are getting a benefit for 3 years. So we can't charge it on the first year only completely or on the last year, because 3 years benefit it is. So 3 years also we are going to divide it on benefit basis. Correct? Basically outstanding basis. Got it? Okay. So how to account for it, sir? Basically bank account debit, whatever the employees give us, exercise price. Employee benefit expense account debit, because it's a expense for us. How much? Value of the option. 2 share capital, that is nothing but the face value. 2 securities premium. Difference between not exercise price and face value, here you should be very careful. It will be a difference between the market value and the face value. Okay, it will be difference between market value and face value. That is for method 1, right? Method 1. If at all vesting period is getting over in this current accounting period only, but the exercise period falling in next accounting period. For example, vesting period is if you stay in the employment with us till 31st March 2025. Till 31st March 2025. Now, if your exercise period, the option given to them to exercise or not, is from 1st April 2025 to 30th June 2025. 3 months exercise period we have given them. Now, you know that only vesting period is benefit, right, to the organization. After completing vesting period, if they leave also, if they want to exercise, they can exercise. So, we have to book all the expense in the vesting period. But exercise will happen in the exercise period. So, that time what you should do, sir? First, you should book the expense in the current accounting period, full. Employee compensation expense account debit to employee stock option plan outstanding account. Okay. Later, when the exercise happens, bank account debit, ESOP outstanding account debit, 2 share capital, 2 securities premium. Basically, in the year in which we incurred, we created a provision. In year in which they exercised, we wrote off that provision. That's it. Okay. Otherwise, if at all we take it as an employee compensation expense in the next year, no. Then what happens? It will be treated as an expense of the next year. It will be treated as the expense of the next year. Got it? Okay. And always remember, expense to be written off to P&L relating to that particular year. Right? This is for when it is getting over in the single year. If at all it goes beyond the year of granting, no. If at all vesting period goes beyond the period of granting, then we are going to divide it into 2. Account could be done in 2 methods. Method 1, first year creating complete provision, right? Whatever related expense is there, that is written off every year on the basis of benefits derived. First year we are creating full provision, right? Whatever required, so much. Then we are going to write it off every year. That one is there. Second one is, people, this year we are going to create the provision only to the extent of expense relating to this period. For example, in my example I told, no, 3 years 30,000. whole 30,000 could be created first only. Later, every year 10, 10, 10, 10 we can charge it to P&L for 3 years. Or first year we will create 10, second year we will create 10, third year we will create 10. Total will be 30. End of the day provision will be 30 only. Every year P&L we are going to write off 10,000s only. But how you are going to show it is the thing now. Got it? Okay. See. When we write off P&L to employee compensation expense, method 1 you see, that is creating a provision to the extent of full. In our example it was 60, correct? So first year only we created full employee compensation expense account debit to ESOP outstanding account. Here listen, employee compensation expense won't be an expense now. It's not a full expense. It's a fictitious asset. We should write off only to the extent of how much is related to this period. So what we will write, ECE to ESOP outstanding. Later to P&L how much we are going to charge only to the extent of how much is relating to this year. So whole 60 we are not going to charge. We are going to write off 20. So P&L account debit to ECE account 20. And second year also will continue with the same thing. Second year no need to create because everything is already created. Second year only you have to write off. That is P&L to ECE 2020. Third year again you will do P&L to ECE 2020. So see first year what is happening? There is a liability of around 60 in terms of provision. At the same time there is a fictitious asset of around 40. Because 60 you debited, 20 you credited, ECE 60 you debited, 20 you credited. So there is a balance of 40. So 20 will be the provision in the first year. Net. Provision side 60, liability side 60, asset side 40. Net provision of 20. Next year if you go, again 20 you write off out of 40. Provision you should keep till the end. Correct? Provision you should keep till the end. So you are going to write off again 20. So now what happens? Provision will be 60 only. Asset side it will become 20. So net provision is 40. Third one, you are going to write off remaining 20. So provision will be 60. Fictitious asset 0. So provision must have created for 60. We created it to 60. Clear up? Okay. Going to the method 2. Method 2, where we are going to create and write off only to the extent of relating to that particular period. We are not going to create whole 60 in the first year. We are going to create only 20 in the first year. So employee compensation expense account debit to ESOP outstanding account 2020. ESOP outstanding is anyhow it's a provision. So we are going to keep it as it is. But employee compensation expense full it is an expense only. So we are going to charge it as P&L to ECE. So now if you see the balance sheet, in the liability side there will be a ESOP outstanding account 20, asset side nothing because we have created 20, written off 20. So first there also it was 60 and 40, net was 20, here also it is 20, which means whatever the method you follow it's not going to affect. Okay. Next, second year again we created the remaining 20. So ECE to ESOP outstanding, P&L to ECE. Next year again we created 20. So like this we created 20, 20, 20, total 60. Liability side it will be 60, asset side nothing. So this is the second method. Got it? When they exercise the option, entry will be bank account debit to ESOP outstanding account to share capital account to securities premium account. Sometimes what happens, our provision what we keep will be more than the what expense it is. Correct? For example, we thought 1000 employees into 100, around 1 lakh stock will be exercised. But at the end only 90,000 stocks are exercised, let's say. But we created provision to what extent? 1 lakh extent. So this 10,000 extra provision will be there, no? That we are going to transfer it to general reserve account. Correct? When we created ESOP outstanding as a credit. Now we are going to debit the ESOP outstanding, credit the general reserve account. This is the table usually what we will do. Year or dates we will write, number of options, outstanding we will write, and opening balance of ESOP outstanding, and total ESOP should have been created so far by taking cumulative, basically cumulative ESOP, right? We will find out difference between how much we actually created, that is opening balance, minus actually we should have created after 2 years, after 3 years. We'll take the difference, will be charged to P&L. If the excess is there, it will be charged to. So that's all. We discussed around 5-6 questions on this. So done with the ESOP.